There are always stock market inefficiencies, and my job is to exploit them. If there weren't any, by the way, I wouldn't exist as a fund manager. So, stock market efficiency is expressed in valuation anomalies. So, what I mean by that is where the share price of a company doesn't reflect the underlying value of the business, either because it's well above the intrinsic value or whether it's below the intrinsic value. My job is to try and find investment opportunities where the intrinsic value of a business is well above the current share price. In effect, a valuation and a pricing anomaly. And you don't get everything right. You don't expect to get everything right. But my job is to try and exploit those. And I do that by trying to understand what's happening in the macroeconomy and understand all that I can about what's happening in the business, both today and where I think the business will be in the future. The global economy has an important impact on all businesses, but not to the same extent. So some businesses like mining companies or oil companies will obviously have a pretty serious level of interaction with what's going on in the global economy, whether it's growing fast or whether it's not growing at all, for example. And there are other businesses like tobacco companies, for example, whose business is not really that exposed to the slings and arrows of the global economy. But ultimately, companies are part of the global economy, and you cannot divorce the two. So when I try and understand what's happening to a business and where I think the share price or the valuation is likely to be in 3 to 5 years' time, I have to consider what the macro environment is going to be over that period of time as well. It's an important part of the investment decision. I am still cautious about the world economy. If anything, I am probably more cautious than I was 18 months ago when I set the business up. So over the last 18 months, really the macro headwinds have got more intense, not least because China has slowed significantly, and the problems facing the Chinese economy, which after all has been responsible for a significant portion of global growth since the recession, since the financial crisis. China is slowing rapidly as it shifts the economic model from infrastructure spending and exports to domestic consumption. It's not going to be easy to pull that off. And I've become more cautious about how long it will take for China to do that in the last 18 months. And at the same time, the global economy has slowed. Europe has slowed. Emerging economies have come under pressure for all sorts of liquidity and dollar-related reasons. Debt overhang is still intense. So all of these factors have played a part in my view that the world economy is probably in a worse place now than it was 18 months ago, and I've become more cautious as a result looking forward. So I think it's right to be cautious, but not too bearish, frankly, because although I think equities are facing a challenging future, I still believe, as I've said on many occasions, that it's possible to deliver high single-digit returns from the right portfolio. But the environment is going to remain very challenging. Okay, the biggest single lesson I've learned over the last 30 years is that successful investment management requires a balance of humility and arrogance. I think you've got to be sufficiently arrogant to back your own judgment. After you've done the work, you've got to believe in your judgment and believe in the calls that you make about the market. You've got to have a view, basically. But at the same time, I think you've got to be sufficiently humble to know that you will make mistakes and not be derailed by them. The other thing I think is important is that the longer you're in the game, the more you learn. And I think you learn from your mistakes as much as you learn from your successes. And it's no surprise to me that arguably the most successful fund manager globally is the oldest. And he's still learning, and certainly I am too.